Brett Sifling's with us, Director of Get Invested, Gerber Kawasaki Wealth and Investment Management, and Will Ryan, Founder, CEO of Granite Shares. Disney had a great quarter, beat, adding more subscribers. Not like Netflix, it's a completely different story. So Brett, I'll start with you. What are your thoughts here as you look at the numbers that Disney has provided?
Yeah, we're really excited about the report. I mean, they obviously beat on revenue, but more important, the profitability of their cash cow, the parks and experiences, was up significantly. We continue to see attendance trends continue upward, double digits. We also are seeing per capita spending up over 40% year over year. And really, this is the cash cow that's driving their business. And it's exciting to see that it's back, and it's back to pre-pandemic levels. It was a second record quarter ever for that segment.
Yeah, it's surprising that they were able to do so well with the theme parks and experiences when it didn't even feel like they were fully open yet. Will?
Yeah, no, I think that was obviously a surprise for people. Hence, part of that in terms of the stock market or the stock price appreciation. But I think in some respects, it shouldn't be too much of a surprise, because I think as the world sort of starts to reopen and people start to go out and spend money, they're looking for experiences. And I think a company like Disney clearly is benefiting from that. That if people have not spent on their usual vacations, their usual sort of discretionary habits over the last couple of years, I think there is that demand. We're seeing it obviously in other sectors, namely airlines and certainly traffic through the airports, that people are willing to get out and spend money. So not too much of a surprise. Real question is, though, how sustainable is this going forward? That once people get their fix, once they have that experience, can they keep getting these people coming back to the parks going forward? And that's really a big question.
Right, and I think that guidance and what will happen is such a big question that everybody has. We agree with you, no doubt. Brett, you came on TD Ameritrade Network when Disney Plus was unveiled, and there was a lot of excitement. I mean, they certainly added more subscribers in such a fast way, unlike Netflix, which we love Netflix, but it's had a tough time of late. So now what? You said you want to see them paying the dividend again, continued growth. What's the outlook here? Are you a fan of Disney, where it's currently trading?
Yeah, we do think it's fairly valued at these prices, but there's a lot to look forward to with this direct-to-consumer unit, Disney Plus. I mean, they've committed to releasing one title a week for the rest of 2022, and that's expected to increase in 2023. So the next quarter might be a little bit tough because they are boosting that spending. But ultimately, they have crushed expectations for Disney Plus. I mean, they thought they were getting to 90 million in 5 years. They're already way past that. They've got nearly 200 million subscribers across all of their platforms now. And really, I do think that they deserve a valuation expansion and multiple because of this tech business that they're growing. And you think about the intellectual property that Disney has and just the deep-rooted emotional connection to the movies and titles. It's clear that Disney's not going anywhere. It's a part of our everyday lives. And ultimately, we're excited to continue to see them grow it, and ultimately it becomes profitable.
Okay, so you think it is fairly valued where it is now. Well, you made the point, we saw Bob Iger stepping down. Bob Chapek now has been talking about the streaming side of things and saying it's a hungry beast to feed, that it's certainly an area of growth that they just need. It's a competitive area, but referring to it as a hungry beast. You also talked about the X-out model and where Disney sort of falls in that. So do you feel like this is a lot to be determined, or that in 1 or 2 or 3 years, this is a winner?
Yeah, so Nicole, I mean, through the lens of our X-out strategy, which, as you know, is designed to exclude stocks. So we're trying to avoid the next Enron. We're not trying to find the next Google. And what we do is we score the 500 largest companies in the U.S. market and then exclude the ones which have the lowest scores. And Disney's just one of these companies that has performed consistently poorly. So it's one of our top 10 excluded companies at the moment. And one of the reasons for that is the Disney Plus, the streaming side, which they're relatively late to the game on that. And it's now a very crowded marketplace. It's a very competitive marketplace. And I think the content, although clearly they have a very extensive library, they still rely a lot on basically princesses and superheroes. And so, that content will have to be diversified if it's going to compete really toe to toe with the likes of Netflix, et cetera. But that's a very expensive business. And so I think when the CEO is making those comments, what he's kind of alluding to is that, don't expect that to turn a profit anytime soon because of the level of investment needed in this crowded marketplace.
And I think that's very interesting, Will, as you bring that to us, because the X-out strategy, as you said, it's not trying to pick out the winners. It's just trying to pick out and weed out the weakest of the bunch, which somewhat worrisome when you think about you're looking at metrics and you're eliminating the strategy and the artificial intelligence, and I know a lot of it's automated too as it filters through, is Xing out Disney. Brett, what is it that, when you look at the group, are you looking at the other media stocks? I know both Netflix and Disney have gotten a lot of Oscar nominations, as you wrote here in your notes, but are there other names that you like better that are similar or competitors?
Netflix has been a darling for a long, long time, and they do have their struggles right now, but we do still like them over the long term. I mean, talking about content, Disney did draw the second most Oscar nominations behind Netflix for this upcoming award season, and they continue to prove themselves. I don't think that they have any shortage of content above princesses and superheroes. I think that they can continue to expand that in the modern world and, continue to get kids excited about being a part of the Disney universe and ultimately all the other universes that they're creating within their ecosystem. It's just a really exciting brand that's not going anywhere.
It's great to see you both, Brett Sifling and Will Rhine. Thank you both for joining us and giving us a good look here at Disney and some of the other names in the group as well. Thank you.